We are continuing with our revision, and today we are doing a KASNEB past paper, CPA, financial reporting and analysis. The question is on group accounting. The question is on group accounting, or what we call consolidated financial statement. We are doing a question of November 2016, question 4. November 2016, question 4. But before that, let me tell you that we have prepared the past papers from 2015 to 2023 and their answers for financial reporting and analysis. If you want to get them for revision purposes, you can follow the link in the comment section below at only cash 300 only. Cash 300 only. Now, let us read the question. The following information was extracted from the financial statements of A Limited, B Limited, and C Limited for the year ended 30th September 2016. A Limited, B Limited, C Limited, and our currency is in shillings million. Non-current asset. At a non-current asset, we have property, plant, and equipment. We have investments, intangible asset. Then we go to the current assets. We have inventories, trade receivables, financial asset at fair value, cash at bank balances. Then we have total asset. Then we go to equity and liabilities, equity and reserve, ordinary share capital of shillings 10 per value. We have share premium, we have retained earnings, and then we have shareholders fund. That is the total of ordinary share capital, share premium, and retained earnings. Then we go to non-current liabilities. We have 10% debentures, deferred tax. Then under current liabilities, we have trade payables, current tax, proposed dividends, and then we have total equity and liabilities. Then we go to additional information. 1. A Limited acquired its investment as follows. A Limited acquired its investment as shown below. We have company, number of shares acquired, cost of investment in millions, retained earnings in million, date of acquisition. So it acquired B Limited. It acquired 16 million shares. The cost of investment was 480 million, and the retained earning at that time was 150 million, and it was acquired in 1st October 2014. C Limited, it acquired 3 million shares. The cost of investment was 120 million, and the retained earning of C Limited at the date of acquisition was 100 million, and it was acquired on 1st October 2015. A Limited also invested in half of the 10% debentures of B Limited. The fair value of the non-controlling interest in B Limited amounted to shillings 120 million. Number 2. Immediately prior to the date of its acquisition, B Limited devalued its non-current asset in readiness for the acquisition as shown below. Equipment, their carrying amount was 250 million. They were revalued to 290 million, and they had a remaining life of 10 years. Then we have the patents. Their carrying amount, or what we call the book value, was 150 million. Then the fair value this is now the revalued amount, was 160 million, and the remaining life was 5 years. Equipment and patents are depreciated or amortized on a straight line basis over their remaining useful lives, respectively. During the year, A Limited sold an non-current asset to B Limited for shillings 180 million. A Limited marked up the equipment at 20% on cost. B Limited included the equipment in its non-current asset and charged depreciation at the rate of 20% per annum on cost. Mhm. B Limited sold inventories to A Limited during the year for shillings 150 million. B Limited marked up these goods at 50% on cost. Half of these goods were still held by A Limited as at the year end. Number 5. A Limited owed B Limited shillings 100 million as at the year end with regard to the transaction in note 4 above. The books of A Limited, however, showed that it owed B Limited only shillings 80 million. A Limited had sent a check to B Limited on 25th September 2016, which was not received by B Limited until 5th October 2016. The group uses the full goodwill method, however, it does not amortize goodwill. Instead, goodwill is assessed for impairment annually. Impairment tests for the year ended 30th September 2016 revealed that none of the goodwill had suffered any impairment since acquisition. Required. You are required to prepare group statement of financial position as at 30th September 2015. As at 30th September 2015. Now, when we are preparing the group statement of financial position, most likely, let us first do the working. And the working that most people like to start with is the goodwill, is the computation of goodwill. And we can start with that. We can start with the computation of goodwill. Uh, so we first see how many shares that were acquired by A Limited. So A Limited is the parent because A Limited it is the company which is acquiring this other company. So it acquired B Limited and acquired 16 million shares, and it also acquired C Limited and acquired 3 million shares. So we can first check these 16 million shares, what percentage of share does it represent? So it acquired 16 million shares. So we come to the statement of financial position and see that the ordinary share capital were 10 per value, were of shillings 10 per value, and B Limited, this is B Limited, had 200 ordinary shares, had 200 million ordinary shares. So this represents 20 million shares. 20 million shares. So if B Limited acquired 16 million shares, then it therefore means that the percentage of the shares acquired, we can calculate the percentage of the shares acquired. It acquired 16. It acquired It acquired 16 million shares, that is 16 million, out of 20 million shares, because the shares are of shillings 10 per value. So this 200 million in the statement of financial position, this now 200 million represent 20 million shares, because it is 200 million, you divide by 10, which is the per value of the shares, and you get 20 million shares. So 16 million shares over 20 million shares, you multiply by 100%, which you get 16 divided by 20 multiplied by 100, you get 80%. So this is the percentage of shares acquired in B. Acquired in B. So it control more than 50%, therefore B is a subsidiary of A. B is a subsidiary of A. We can also check for C. We can check for C. Now it is the percentage of shares acquired in C. It acquired, we are told it acquired 3 million shares. It acquired 3 million shares in C. Out of how much? Out of how? So C had 100 million. So this is 10. This is 10 million shares, because it is 100 million, that is the value in shillings. You divide by 10, that is because it is each shares costs shillings 10, and then if you do that, you get the number of shares. So it acquired in C, it acquired 3 million shares. So we are saying it is 3 million out of 10, multiplied by 100, which definitely we are getting, 30%. We are getting 30%. Therefore, C is an associate. C is an associate. C is an associate. And you know, in group, we don't consolidate associate, we only consolidate subsidiary, and then the associate, we usually only account for one figure, which is called the investment in associate, Therefore, let us first calculate the goodwill in uh, acquisition of B Limited. So we start with the cost of investment in shares. The cost of investment, we have been told it is, the cost of investment is 480. Then the NCI, the non-controlling interest, remember here we are using the full goodwill method, is 120. So we start, that is 480. cost of investment in shares. Then we have our NCI. Our NCI is 120, but before our NCI, we have the cost of investment in debentures. We have been told that A Limited also invested in half of the 10% debentures of B Limited. So we check how much is the debentures of B Limited. 10% debentures, they are 200. So definitely half of them is 100. Remember, if a parent acquires debentures in the if a parent acquires debentures in the subsidiary, you're supposed to debit those debentures which are acquired. You're supposed to debit them in your cost of control account. So we put 100 there. That is the cost of investment in venture, because the total number of debentures, they are 200. So if you divide that one by 2, if you divide that one now by 2, if you divide that by 2, you are getting 100. Then the NCI, we have been told it is 120 million. The NCI is 120 million. So now the total of this is 700. Now we go to the net assets acquired. We start with the ordinary shares. We go to the net assets acquired. We start with the ordinary shares. Ordinary shares, we are taking the total of the total number of ordinary shares, because we are using the full goodwill method. So we take 200. We take 200. Then we go to the retained earnings. The retained earnings, we have been told it was 150 million. The retained earning is 150 million. Then we go to the share premium. We go to share premium. How much is the share premium? The share premium in B was 100 million. 100 million. Then we go to the half of 10% debentures which were acquired, which is 100. Remember, when you're talking about the debentures, the cost of acquiring the debentures can be included here in the cost of investment. So you have to check the question very correctly to make sure you understand whether the cost of acquisition of debentures is combined with the cost of investment, or it is not combined. But in this question, it was not combined. Then we go to increase in the fair value of equipment after the revaluation. The equipment were revalued from 250 to 290. Therefore, the increase there is, let us calculate it here, 290. The increase is from the increase was from 250 to 290. Therefore, the difference is 40. There was an increase in the fair value of equipment by 40 million. Then the increase in the fair value of patents they increased from 150 to 160. So there is an increase of fair value of the patent by 10 by 10 million. If we add all of these, we are getting, if we add all of these, we are getting 600. We are getting 600. We are getting 600 million. We are getting 600 million, which means that our goodwill is 100 million because it is this 700 minus 600, where 600 represent the net assets which were acquired. Then working 2, we go to the fair value of investment in associate C Limited, fair value of the investment in associate C Limited. We have the cost of investment in shares of C Limited now. Now we go to C Limited. The cost of investment is 120 million. And the retained earnings at the date of acquisition is 100 million. And the retained earnings at the end of the year is 350. The retained earning at the retained earning at the end of the year is 250 million. Now we are in C Limited. So the retained earning at the end of the year is 250 million. So if we go to C, cost of investment is 120 million, and then the share of post-acquisition retained earning is 45. The share of post-acquisition retained earning is post-acquisition is now the profit which were earned after this associate was acquired. So the total profit in the statement of financial position is 250. Then you deduct the retained earnings which was there at the date of acquisition, which is 100. Then the amount that you get here, you multiply by 30%, because the reason you're multiplying by 30% is because our parent, which is A, control 30% of, it control 30% of C. It controls 30% of C. So we multiply by 30% there. And if we do that, you're getting 45 million, which means that our investment in associate is 165 million. Then we have been told that immediately prior to the date of its acquisition, B Limited revalued its non-current asset in readiness for the acquisition as shown below. So if it revalued these assets from 250 to 290 million, and then the patents were revalued from 150 to 160, then it therefore means that uh, B Limited, if B Limited continued to calculate depreciation based on based on the book value, based on the cost of this equipment at the cost of the patent, because they are using the straight line basis. They're using the straight line basis. Remember, if you're using the straight line method of calculating depreciation, then it means that you are depreciating your assets. You are depreciating your assets on cost. So if they continued depreciating based on the cost, then it means that uh, at the date of uh, consolidation, at the date of consolidation of the financial statement, there was a depreciation, under charge. There was a depreciation under charge. So we calculate the depreciation under charge, which is also called the additional depreciation, and let's call it the depreciation, and let's call it depreciation under charge on equipment. Depreciation under charge. Under charge on equipment, which now it is, we are going to take 290 million, we deduct 250 million, because that now represent the increase, which is 40 million. We divide that one by the remaining useful life of 10 years. And if we do that, and then we check when was this, we see that B Limited was acquired on 1st October 2014, and we are consolidating our financial statement on 30th September 2016. So the depreciation under charge is for 2 years. That is from 1st September 2014, from 1st October 2014 to 30th September 2015, and from 1st October 2015 to 30th September 2016. So the depreciation under charge here is for 2 years. So we multiply by 2 years. And if we do this, we are getting a depreciation under charge of 3 million. Then we have the amortization under charge. Amortization, because patents are usually amortized. So amortization under charge. So we take 160. We take 160, which is the fair value now. We deduct 150, which is the book value. So we get there's an increase of 10. We divide by the useful life, which is the remaining useful life, which is 5 years. Then we also multiply by 2 years to get the amortization under charge of 2 years, because we are consolidating in 2016 and this subsidiary was acquired in 2014, which now we are getting 4 million, which we are getting 4 million. Then in our working number 4, we calculate the unrealized profit on sale of non-current asset by A Limited to B Limited. In additional information number 3, you are told that during the year, A Limited sold an non-current asset to B Limited for shillings 180 million. A Limited marked up the equipment at 20% on cost. B Limited included the equipment in its own non-current asset and charged depreciation at the rate of 20% per annum on cost. So we first calculate the unrealized profit, then we calculate the depreciation overcharge by B Limited, because A Limited sold this equipment for 180 million at a markup of 20%. And remember, if a group sells an asset to a member of the group, then there's no profit which is made, because you cannot make profit by selling to yourself. One of the principles of consolidation is that you eliminate the intercompany transactions. You eliminate the intercompany profits and transactions. So the unrealized profit is 20%, that is 20 out of 100. We multiply by, no, it is 20 out of 120, because it was a markup, not a margin. 20 out of 120, then we multiply by 180, which we are getting 20 out of 120 multiplied by 80, 20 out of 120 multiplied by 180, we are getting 30 million. 30 million. That now is the unrealized profit. And now we calculate the depreciation overcharge on the non-current asset. So the depreciation overcharge now is going to be 20 out of 100. We multiply by 20 out of 100, we multiply by this unrealized profit, because this now is represent this 30 million now represent the markup. So we multiply by 30 million, which we are getting 6. We're getting 6 million, which we are getting 6 million. Then we calculate the unrealized working 5. We now calculate the unrealized profit on sale of inventories by B Limited to A Limited. We are told B Limited, in additional information number 4, B Limited sold inventories to A Limited during the year for shillings 150 million. B Limited marked up this good at 50% on cost. Half of these goods were still held by A Limited as at the year end. So we calculate the unrealized profit on the stock which is still held at the year end by A Limited. So uh, the unrealized profit is 50% out 50 out of 150 because the good were markup, because the sales was a it was a markup, not a margin. So that is why we are taking 50 out of 150. If it was a margin, then we could have then in this case we would have taken 50 out of 100, but now it is a markup. That's why we are taking 50 out of 150. And then we multiply by this good. The goods were valued at 150, and then we multiply by the stock which was remaining at the year end, which now is a half. The stock which was remaining at the year end is a half. If we do this, we are getting an realized profit of 25, unrealized profit of 25 million. So because now this was an upstream sale. An upstream sale is whereby a subsidiary sells to the parent, and a downstream sales is whereby now the parent sells to subsidiary. Because this was an upstream sale, we are going to calculate the parent share of unrealized profit and subsidiary share of the unrealized profit. So the parent share is 80% because the parent control 80% of B. So it is 80%. That is 80 out of 100. 80 out of 100. We multiply by 25 million, which we are getting 20. We are getting 20 million. Then the subsidiary share, it is just 20%. 20% out of 100. We multiply by 25, which we are getting, that should be 5 million. That should be 5 million. So now we are done with working number 5. We go to working number 6, where now we are going to calculate the retained earning in B. That is the retained earning in B. So now this is the post-acquisition profit. The post-acquisition profit in B, we check in the statement of financial position. The total retained earnings in B is 350 million, and the retained earning at the date of acquisition of B is 150 million, which means that our post-acquisition profit is 200 million. We are saying that the total retained earnings in B is 350 million, and the retained earnings at the date of acquisition was 150 million, which means that this is the post acquisition profit or the post-acquisition retained earning is 200 million. This is the profit which was made when B was from the date when B was acquired up to the time now we are consolidating the financial statement. Then we add back the depreciation overcharge on non-current asset in the working note number 4. The depreciation overcharge on the non-current asset is 6 million. Remember, if expenses have been overcasted, it means that our profit is undercasted. So to rectify that kind of an error, you add back that expense to the profit. In this case, the depreciation is overcasted, which means that the profit was undercasted. So we add back that depreciation overcharge of 6 million. Then we raise the unrealized profit on sale of inventory in our working note number 5, which now is 5 million. We are only taking the subsidiary shares, so it is 5 million. 5 million. Then we have the depreciation undercharge, the depreciation undercharge on equipment. So let us call this one the depreciation undercharge, the depreciation undercharge depreciation. This one is undercharged amortization. Undercharged amortization. So the depreciation undercharge on equipment is 3 million, and the depreciation undercharge on equipment is 3 million, and the amortization undercharges is 4 million. So we deduct the undercharged depreciation on equipment in working note number 3, the undercharged depreciation on equipment, which is 8 million, deduct 8 million. So this one is 80 million, not 3. This one is 80 million. And then the undercharged amortization in working note number 3 is 4 million. So we deduct 4 million there. And if we do that, we are getting our adjusted retained earning as 189 as 189 as 189 million. So the group share, that is the A limited, which is the group share, is now 80% times 189, which is 151, 151.2, and the NCI share, it is 20% times 189, which is 37, which is 37.8, which is 37.8. Then we go to the NCI, that is B limited. The NCI, we have the fair value of the NCI at acquisition. The fair value, we were told it was 120 million, and now we just add their share of the post-acquisition profit, which we have calculated here as that 7.8. If we do this, we are getting the total of the NCI share as 157.8, 157.8. Then we go to A limited, working 7, we now go to A limited group retained earnings. So this is the group retained earnings. So we check in the statement of financial position, the group retained earnings, we first check the retained earnings of A, which is 400 million. The retained earnings of A is 400 million. We less the unrealized profit on sale of non-current asset in our working note number 4, which we got 30 million. And then we raise the unrealized profit on sale of inventory, working 5. This is the parent share, which we got 20 million. Then we add the share of post-acquisition profit in associate C limited. So this is the post-acquisition profit in the associate, that is C limited, is 250, because that is the total retained earnings in the associate C. We deduct the retained earnings at the date of acquisition, which are 100. Now, if we take all the retained earnings, we deduct the retained earnings at the date of acquisition, we now have the post-acquisition retained earnings, and therefore we take 30% of this. So we now multiply by 30%, because the parent will share 30% of the post-acquisition retained earning, and if we do this, we are getting 45. Then we have the share of dividend in associate C limited, the share of dividends. So we have the proposed dividend. The associate was proposing a dividend of 50 million. So the parent will share. So we get 50 million. We multiply by 50 million. We multiply by 30%. We multiply by 30%, which now we are getting 15. We are getting 15 million. Then the share of dividend in the subsidiary, it is 80. It is 100. We multiply by 80%. We multiply by 80%, which now we are getting 80, which we are getting 80 million. And then we have the share of post-acquisition profit in B Limited, which now we have done in our working, number 6, which is 151.2, 151.2, 151.2. If we add all of this, we get the group retained earning as 641.2. The group retained earnings is 641.2. We can now go to into working 8, where we now calculate the value of property, plant and equipment. The value of property, plant and equipment. So we have the property, plant and equipment in A is 950. In B, it is 750. The increase in fair value of the equipment is 40. That one, because it is 290 minus 250, it is 40. The depreciation overcharge in working 4, that is the depreciation which was not supposed to be charged, is 6 million. And then we raise the unrealized profit on the sale of equipment in our working note number 4, which we got as 30. Then we also deduct the depreciation under charge of the equipment, which is 8. So if we do this, the total here is 1746. 1746. So the balance carried down, it is 1746 minus 30 minus 8, which you are getting 1708. And if we balance this account, getting 1746. Therefore, we are done with our workings. The other workings, we will add them line to line. We will add them line to line because they don't involve a lot. So we can come here to the statement of the statement of financial position. This is the A Limited group statement of financial position as at 30th September 2016. So we have property, plant and equipment in our working note number 8, which you have just finished. It is 1708. So this one is 1708. Then we go to the intangible asset. We have the intangible assets of A, they are 200. We add the intangible assets of B, which are 150. Then there was the increase in fair value of the intangible asset by 10 million because they were valued from 150 million to 160 million. So that there's an increase in fair value by 10 million. Then we less the depreciation of 4 million. That is the depreciation which was undercharged. The depreciation which was undercharged of 4 million. And if we do this, we are getting the value of our intangible asset as 356. We are getting the value of our intangible assets as 356. Then we go to the investment in associate. The investment in associate, we had done this in our working note number 2. The investment in associate, we got 165. So that is 165. Then goodwill, we had done goodwill in our working note number 1, which we got 100 million. So that is 100 million. So if we add all of this, we add all of this non-current asset, we are getting the total value of non-current asset as 2,329, and our currency, remember our currency is in million. So now we go to the non-current assets. No, we are now done with the non-current asset. So now we go to the current assets, where now we start with the inventories. The inventories for A Limited, it is 250. We add the inventories for B Limited, which is 200. Then we less the unrealized profit on the closing value of inventory, which is 25. We have done this working. So if we do this, we are getting the value of our inventory as 425. Then we go to the trade receivables. The trade receivables of A, they are 220. The trade receivables of B, they are 170. Then we raise the intergroups. We raise the intergroup trade receivables, which we were told it is 80 million. And of course, there was cash in transit of 20 to get our balance of trade receivables as 290. If we do this, we are getting the trade receivables as 290. Then we have the financial asset at fair value. For A, the financial asset at fair value, for A Limited, it is 180. For B Limited, it is 130. So if we add them, we are getting 310. If we add them, we are getting 310. If we add them, we are getting 310. we are getting 310 million. We continue to the dividend receivables. The dividend receivables from the associate, those are just 50 because 50, we multiply them by 30% because the parent, which is A Limited, control 30% of C Limited, which is an associate. So we multiply by 30%, which we are getting 15 million. Then we go to the cash and bank balance. We now go to the cash and bank balance. The cash for A is 100 million. We add the cash for B is 50 million. And remember, there was cash in transit of 20 million. The cash in transit means this was the check which was sent, but it was not yet received. The cash in transit means that it is not either in A or in B. It is not either in A or in B. So you have to make that cash to be received. So that is the cash in transit. It was sent, but it has not yet arrived to the destination. And if you do this, you are getting your cash and bank balance of 170. You get them as 170. So we add all of these current assets. If we add all of these current assets, we are getting 1210. We're getting 1210. Now we add them to the non-current assets. If we add them, so that is 1210 plus 23, 29. 1210 plus 23, 29. We are getting 35, 39. Getting 35, 39 as the total assets. We now go to the equity and liabilities. So we start with the ordinary share capital at shillings 10 per value. The ordinary share capital, we just take the shares of the parent. Then we have the share premium, it is 200. We just take the share premium of the parent. So the ordinary share capital is 500. The share premium is 200. And the group retained earnings in our working note number 7, the group retained earnings in our working note number 7, we got 641.2. 641.2 And the NCI in working note number 6, the NCI is 157.8. 157.8. So if we add all of this, if we add all of this, we are getting 1,004.99. 1,004.99. So we now go to the 10% debentures. The 10% debentures for the parent, we have for the parent we have 600. So the 10% debentures for the parent we have 600, and then you add the 10% debentures of the subsidiary which were not acquired, that is half, so it is 100. So here we have said for the parent it is 600, and for the subsidiary it is 100. So you are getting your total value of debentures as 700. Then you go to the deferred tax. You go to the deferred tax now. For A limited it is 250, and for B limited it is 100. So you get your total of deferred tax as 350. Total of deferred tax as 350. So your total non-current liability, is 1050. It is 1050. Then we go to the current liabilities. We go to the current liabilities. We start with the trade payables. For A, we have 300 as the trade payables. Then for B, we have 250 as the trade payables. Then we raise the intra-group trade payables of 80 million. So we get our balance of the trade payables as 470 million. That is the balance of the trade payables. Then we go to the current tax. For A, the current tax for A is 250, and for B, current tax for B, the current tax for B is 150. So if you add this together, you are getting your current tax as 400. If you add that together, you're getting your current tax as 400. And now finally, you go to the proposed dividend. You go to the proposed dividend. For A, it's 100. For B, it is 100, and then you raise the intra-group proposed dividend of 80. These are the dividends that B is paying to A, and if you do that, you are getting your balance of the proposed dividends as 120. You're getting your balance of the proposed dividend as 120. So if you add all of this, you are getting your current asset. You're getting the total of your current asset as 990. 990. So we add current. No, these are current liabilities. Sorry, these are current liabilities. These are current liabilities. So you are getting your total value of current liabilities as 990. So you add current liabilities to non-current liabilities and to the equity and reserves, the equity to the owner's equity. And if we do that, so that is 1499 plus 1050 plus 990. So we are getting that 5. We are getting that 539. Sorry for some of the mistakes we have made, but for any further clarification, you can post in the comment section below. You can post in the comment section below. Thank you. I'll see you in another video.